The stock market continues to hit all-time highs, and we had Bitcoin surge above 100,000 this week. I'm going to bring in Jim Welsh of Macro Tides to talk with us about what has been happening in this market. And Jim, here we are at new all-time highs once again.
Yeah. Yes, we are. And again, my expectation, because we didn't chat last Friday,
Yes.
but in this past Monday's weekly technical review, my take was I think we're going over 6,100. So 2 weeks ago when we talked, it was like 6,017. And so my expectation was that we would see higher prices. There's no reason to sell right now. People are very, very bullish, which is a caution thing. But in the short run, if everyone's bullish and they've got all these reasons why the market is going to just keep going higher, that means they're not going to be a seller either. And so to me, that's the dynamic that needs to change. I think it will change as we get into next year. But in the very short term, lack of selling doesn't means that there doesn't take as much buying pressure to keep pushing prices.
Sure. And wouldn't you agree? And we're just coming off the jobs report. I mean, we created 227,000 jobs. I know unemployment rate ticked a little higher, but still, I mean, that's a Goldilocks scenario, right? I mean, that's what the markets want to see. They want to see unemployment rate ticked up a little bit, so the Fed's like, yeah, we can still ease. We can still,
Yeah.
lower rates another quarter basis point, but the jobs market, we're still creating jobs. We beat the
Yep.
consensus. So this is hey, Fed's got our back.
Yeah.
Trump's coming in office. Jobs
And
market
he's going to
isn't
make
bad.
everything even better. Okay,
Yeah,
that's kind
yeah.
of
We could just
the idea.
we could just
Um,
buy anything, right? I mean, is that the key today?
that's what's so in terms of the Fed, I think the Fed is going to cut when they meet on December 18th. The main reason almost has nothing to do with any of these numbers because none of the numbers were so bad as to, I think, take the rate cut off the table. But the one common denominator, if you listen to the minutes, the speeches by various FOMC members, Blake, is they all think the current funds rate, which is at what, 4.5 to 4.75, is at a restrictive level relative to whatever the neutral rate is, and nobody knows what the neutral rate is. But they all believe it's restrictive. And so I think there's going to be two reasons why they will cut the funds rate. A, because they want to narrow that gap and they think it's justified. Number two, as we go into next year, and Powell talked about this, I think in the press conference, he was asked a number of times. Nobody knows how the trade negotiations are going to go, how much tariffs are going to be applied on which goods. So the risk of there being a blip up in inflation because of the tariffs, nobody knows that number as well. We
Well, wait,
don't
wait.
know.
So but the first chart you brought is about tariffs. Is this a good time for me to
Yeah,
put
yeah,
that
yeah.
chart up?
Let's go into that real
Oh,
quick.
okay, let's do it. So I'm going to do it right now.
So yeah, the difference this year, or at least right now where we're at, versus 2018, was the tariffs were pretty much restricted to China. And so this chart shows the tariffs on the goods that we were importing from China. And you can see that over a 2 year period, the prices of those goods went up, but everything else went down. And so net, it was kind of a push. There really wasn't much inflation that came from those tariffs back in 2018. The risk is there will be more inflation because we're talking about China, not just China, but we're talking EU, we're talking Canada, we're talking Mexico. So this also will create some of the uncertainty for the Fed because they don't know the answer to these things. I think it's also why they'll justify, you know what, let's get another rate cut in, and then we're going to wait for a while.
That makes
You know,
sense.
and then we're just going to see how all this stuff plays out. And when we get more information, then we'll be able to make an informed decision. So I think the Fed is going to cut when they meet on December 18th. At the same time, the markets may come to realize that may be the last cut for a while. And how we'll see how the equity market handles that. I think that could at least be mark a short-term high as we approach that meeting date. But anyway, that's I think one of the things that is going to drive the Fed to decide, yep, the policy rate's still restrictive and we have so much uncertainty. Let's get one more rate cut in, and then we're going to sit on our hands for a while.
Well, Jim, I'm glad that you're here this week because I know we missed you last week and hope you had a wonderful
I
Thanksgiving
missed you
holiday.
too.
But this week we have coming up, and I'm excited to get into this. We have
Yeah.
CPI, and I think it's going to be a
Yep.
potential market mover. So you brought the CPI table. Explain to us what you mean by,
Yeah.
or what this chart means to us.
Well, there's two things we're going to talk about. The first thing is just the simple math, and we've discussed this previously in terms of you take the number from 12 months ago, and then you add the current data point in. And that's how you get the year over year calculation on the CPI, as well as the Personal Consumption Expenditures Index, the PCE. They're all calculated the same way. And a few weeks ago, I wrote about if you looked at both the PCE and the CPI, what you can see is in October, November, and December, there were really pretty low numbers coming off from last year. 0.08, 0.16, what's the other one? 0.19 or 29. And so what that
Point
implied to
two
me
three.
is, yeah, okay, thank you. Um, we were going to see the CPI go up, and the same math works for the PCE. And when the number came out a week ago, it did go up. And so going into year end, these low takeaway values were going to lift PCE and the CPI inflation. So if you look at, we're going to take away the number from November of 23, which was 16 basis points on the headline. And if the CPI comes in at 24, which is what it was last month, you could see a 1/10 of a point increase from 2.6 to 2.7. The core, because you're taking away 31 basis points, will probably stay pretty close depending on rounding. So the impression is at 2.7 and at 3.3, these numbers are not near 2%. And so people will, oh my goodness. But if we go forward and you look at for January of this year, remember we had three really bad inflation reports in January, February, and March, and even April. And you can see 31 bips, 44, 38, 31. The core were all elevated. So that if you start looking at, well, what if we hold inflation at relatively the same mark that we were in October? We're going to see a fairly decent decline next year in these inflation numbers. So you get a bump up and then a decline. That's one of the things that Powell talked about was this 12-month rate of change of, well, some of the values we're going to be taken off as we get into next year are really going to, bring it down. So we're going to get a bump up and then down. So my point is, I don't think a higher CPI next week is going to dissuade the Fed from cutting at the December meeting because they know the way these numbers work. And they know as we get through the first 3 or 4 months of next year, we're going to see the CPI drop down closer to, it will, in March, it could get down close to 2.1%. And the PCA will probably be below 2.5. So the Fed knows this. And then the other thing that Powell talked about, and that gets, I think, to the next chart, is how inflation bleeds into both the PCE and the CPI from shelter. And in 2021, as we all remember, Powell and company said, oh, it's just going to be transitory. And what they missed, and I wrote about this back then, Blake, that housing takes 12 to 18 months. So as we were seeing rents explode in 21 and 22, that meant that we're going to see higher inflation 12 to 18 months from now just from this shelter. And shelter is about 40% of the CPI, and I think it's around 20% of the PCE. So what these two charts show on the left-hand side, if you look at current rents, and again, Powell has talked about this, that if you look at where apartment list, Zillow, they have current numbers. So if you replace the methodology in the CPI and PCE with using current data as opposed to the way they calculate it with this huge lag time, inflation would have been, the rent in October was 4.8%. But if you look at the apartment list, it was minus 0.7. So again, Powell knows this. If you incorporated that data from apartment list, the current rent stuff, inflation would have been much worse in 22. You can see it got much higher relative to the official data points on the chart on the right. And then if we look at, well, where would it have been in October if we were using this data? Well, the headline CPI was what, 3.3? Using this current rent stuff, 1.76. So my point is, Powell and the members of the FOMC know that, yeah, the 12-month rate of change calculations were going to lift inflation through the end of this year, but then they're going to bring it down. And more of, given the way they calculate shelter with this big lag, these numbers that we're seeing from a current number, they will start to show up progressively in the CPI calculations. And that'll be another reason why the CPI, to a greater extent than the PCE, will come down more aggressively as we go through the first 3 to 4 months of next year. So again, looking under the surface, we can see why this uptick in inflation the last couple months, and I think it'll continue when we go through December and we get that data in mid-January. The Fed is not going to be that concerned, because they think that, okay, we got to bump up and then we're going to see it come down. And at some point in time, as we get into next year, more and more of the current rent inflation data will bleed into the CPI calculations and be another depressant on CPI inflation more than the PCE, but both of them are going to have the same dynamics. So again, you look at 3.3% and like, wow, that's way above 2%. Well, these calculations are reason why. It's in a sense falsely inflated.
Okay. All right. Well, that makes sense to me. The
Yeah.
next chart you brought, Jim, was the is small business loans. So why did you
Yeah.
bring this chart to
Well,
us?
I brought it because, again, and we may have talked about this last week. Trump got reelected and won the popular vote for the first time for a Republican since 2004 because people who had previously pretty much always voted Democratic went for him. And we've talked about this. The bottom 40% or so of people uh, don't feel the economy is good. I mean, the polls right before the election showed 65% of the people said the economy wasn't good or was bad. That's
Yeah.
2 out of 3 people. Well, why are they saying this? Well, because they're under pressure, and they're under pressure because of higher prices. All that excess savings went bye-bye as we got through 23 and 24. Well, small businesses are kind of in that boat too, Blake, because look at their cost of borrowing has gone from around 5% to 10%. And so, yeah, the Fed has cut the funds rate. They're going to cut it again, as they said, I think, when they meet in December 18th. But that isn't providing a whole heck of a lot of relief. If you're a small business owner, your wages costs, labor costs are going up, and your borrowing costs are pretty high. And then the chart on the right shows ADP. They come out with an overall number, but then they break it down by a lot of categories. And in their report for November, small businesses shed 17,000 jobs. And why this is important is because small businesses create at least 50% of all the jobs created in the country, month, over time, come from small businesses. So again, my point here is the economy is so bifurcated. You have segments that are doing really well. If you've got a house, you've got assets, if you've got Bitcoin, man, you couldn't have it any better.
Yeah.
But if you're renting and you're living paycheck to paycheck, and you're a small business owner trying to keep your doors open and everything else, you're living in a different world than the people with assets. And so, to me, what that implies is at some point in time, if we see asset prices decline, and that's going to happen. I mean, it's not like, okay, we're never going to have a 20% decline in the stock market again. Then those on the upper end will pull back. And I think that's what's coming next year. But again, this was just to say, okay, folks, everyone is really ebullient about the markets and, oh, Trump is going to make it even better and so forth. These charts show, well, there's a whole segment of the population that are small businesses being very important. Their world is a little different, than,
Well, Jim, I don't know. Janet Yellen said we're never going to see a recession again. So, and I don't know if she said in her lifetime or ever again, just in general. So
Yeah, I think she said no financial crisis too ever again. And, I don't know how long she's going to live, but there will be another financial crisis and there will be another recession. And she was, to me, one of the most partisan. When she left the Fed, it's kind of like her true colors came out because she was so partisan as a Treasury Secretary. And so, I lost, personally, I lost a lot of respect for her because, deficits were terrible when they were under Trump. But under Biden, which were even bigger deficits, well, that's okay. It's like, come on, you can't have it both ways,
yeah.
Janet.
Yeah. All right.
So
Well,
anyway,
we'll see. We'll see if there's going to be any type of financial crisis. I can't foresee one, Jim, with Bitcoin surging the way it's surged. So,
yeah,
you pull up a chart, and I mean, what sticks out like a sore thumb here, other than that big five that I see up there?
yeah, that's it, baby. I mean, from 15,000, you can kind of see a pretty clear one, two, three, four, thrust up for five. Whether it's complete, in other words, we may have finished at 103,000 wave three of five, and so there'd be a four and then another pop. But from a perspective standpoint, should you be a buyer north of 100,000? No. And I understand you had a very prescient call on Bitcoin. And I want you to share that to listeners because it was a terrific call.
Well, this, and you can't see it because we're missing part of the chart over here, but it's a cup and handle
Yeah.
pattern, and that measurement is perfect. And this is also 161% extension. Fibonacci golden ratio comes up at
Yep.
103,800, I believe, and
Yeah.
we scaled that by about $200, which is nothing in Bitcoin land. So yeah, it's
Well, and somebody has priced 100,000.
yeah, yeah,
$200 is what, 0.002 or something. Anyway,
yeah.
so my own
It's
point is I think Bitcoin here is nearing a top. We know the enthusiasm level is through the roof. Nice, huge round number. Things have a tendency of struggling at round numbers. Plus, the notion that Trump is all in on Bitcoin. That's why you had such a huge spike. He nominated somebody to run the SEC who's far more favorable than the old guy was. So to me, these are all reasons why it's time, even if you're longer term bullish, you have to keep in mind that in the last bunch of years, I think Bitcoin's had three corrections north of 70%. What I'm showing here is a 382 retracement from the 15,000 up to the 103 and change, gets you 69,000. Well, if you get a 50%. So anyway, my point is all the signs of a top are there in terms of enthusiasm and the pattern and your calculations that you just shared all kind of say, well, now it's time to probably lighten up. Even if you're long-term bullish on Bitcoin, this is a good place to lighten up, and you'll probably have an opportunity to buy it $20 to $30,000 or more, lower than where it is trading today.
I was just going to ask. Go say. So you're thinking we're probably heading back towards 70,000, somewhere in that neighborhood.
At least, I mean, again, going back to that trading range around 70,000, as I said, the 382 gets you down to 69,000. 44,000 from 103 is what, 59,000 if you did a 50% retracement.
Yep.
So to me, again, this is just like, I don't know where it's going. It'll get down to some level that you can kind of say, all right, it's probably time to buy again. It won't be a straight line. It'll be choppy because the first parts of the declines are going to be people, it drops to 80,000. Oh God, I gotta buy it. It's down, so it'll bounce. But I just think over the next 6 to 12 months, there's a better buying opportunity coming.
All right. Well, Jim, I would say it is one scary looking chart. And one of the things I guess I want to stop real quick and just say that a lot of money has been made here. A lot of
Mhm.
money has been made in the crypto market, and it's been pretty massive. So if you have been participating in it, there's an old adage, and you probably know it too, Jim, is I never met a rich or a wealthy investor going broke taking profits, right? So
Right, right, right.
There's
No,
something to be
I
said
mean,
about that.
no, there's a lot of people, to their credit, they bought it, they believe the story, they're hanging in there and all the rest of that. But something goes up over 600%, to your point, you're playing with house money here. Take some of the whatever you've got in there, because there's going to be a correction, even if it's going to 200,000, even if
Right.
it's going to a million. I
Yeah.
mean, so anyway.
No, I think it's those are wise words, Jim. So sorry, I'm just doing something real quick. The next chart you brought here is
Yeah,
going to be
bottoming.
yields. So what's going
Yeah.
on with yields?
Okay. So as you know, I've been looking for treasury yields to come down. And they have. And the thing that to me is most encouraging is with today's rally in response to the employment report, you can see on the 30-year Treasury, one, two, three, four, five in terms of yield. If you looked at price, you would see one, two, three, four, five going up. And TLT, one, two, three, four, five going up. My interpretation here, Blake, is even if yields ultimately are going higher, what we'll see is that five waves down on treasury yields. There's two paths. Either that's five down for a wave A, and we'll get a choppy period where yields tick up a little bit, and then we'll have another five-wave decline that will bring yields down, was it about 37 basis points approximately?
Yeah.
So if it got up to 450, just to make the number simple, you're talking getting down to 412. All right. The bullish count is that five waves is the beginning of a rally that will take like the 10-year down to three and a quarter to 350. The 30-year will get down near 350. TLT will get up above 101.64. That's the bullish. But this five wave down tells me that, all right, we get this correction where yields tick up, bond prices pull back. You want to be a buyer on that pullback because there's likely to be another rally that's as big as the one we've just seen over the last month. And so to me, having this five down, it was from my perspective that I think TLT is going north of 101.5 and the treasury yields are going to drop more, take out their lows that we saw in September. So, this is like, okay, this is good news, at least from that perspective.
This is something you
So,
want to see develop.
and it did,
Yeah.
thankfully. And,
Yeah.
and so again, I think that the economy is going to slow more than people realize. And we'll talk about that in a second when we get to the S&P chart.
Okay,
So
well, let's a little bit before we get there, and we're almost there, guys. We want
we're
to talk
getting
about
there.
gold because gold hasn't done squat.
Yeah,
What?
I mean,
No, wait, real quick, Jim. I asked traders like our community that I trade with every day. I'm like, do we see 2600 or 2660 split down the middle on
yeah,
on
yeah,
on
yeah,
uh, on on opinions? So what do you think?
yeah. Well, I think wave three ended at 2789, and that's going back to the low that was like what, the low 1600s or something
Yeah.
in July of last year. So I think we're in wave four. Wave two from that low took about 4 months. So waves two and four should be at least somewhat close in time. Well, that kind of suggests that this correction is likely to last until mid-February to mid-March. So, from a timing standpoint,
Somewhere in
number
August.
two, the pattern is likely at some point in time, gold's going to take out 2541. So, if it does it in a very simple, direct manner, 2478 is one of the targets. You had a $241 decline, you bounced to 2719, you get another $241 decline, you're 2478. Very near term, honestly, there's a chance it could bounce above 2719 and then drop below 2541. Or it may just puke here and drop below 2541 to complete the first part of this correction that I think is going to last for 4 months. So near term, for me, it's a coin toss. But if it gets below 2541, I think that'll provide a short-term buying opportunity for a bounce in the middle of this corrective period.
So Jim, before we get into, and I'm glad you talked about this with gold, and I want to talk to you real quick about this before we get into the dollar and the S&P.
Yeah.
Well, a couple of things. If you guys enjoy what Jim's telling you here, make sure you give him a big thumbs up, subscribe to the channel, email Jim. He'll give you his email address at the end of this show so he can talk about what he does over at Macro Tides. But I want to ask you this question first. How much do you take into seasonality and positioning and end of year flows, especially this year? Because look, you've been around the markets a long time. I've been in the markets almost 3 decades now. Since 1996 is when I got my series 95, excuse me, is when I got my series 7.
Hmm.
So I'm old enough to remember when having a 3 to 5% return in the stock market was actually a good year. This year's we're up 30% year to date,
Yeah.
and then
Yeah.
some, maybe even more
Yeah.
than that, depending on what index you're looking at. And how much window dressing, chasing, positioning, flows do you pay attention to? Real quick, I wanted to ask that.
Well, you have to pay attention to that because money moves markets. It's that simple.
Yeah,
Positioning, I think, is really important. So, a month ago, when gold was up around that 27, that high,
yeah,
I showed charts showing positioning that that the number of long contracts by speculators was, I don't know if it was 300,000. I'd have to look at the chart again, but it was excessively high in that in the past when we got to those levels, gold had had corrections, 15% or more. So that was definitively for me one of the reasons why, okay, we're about to have a correction that's just not going to be able to dip. It's going to be deeper and it's going to last longer. And then the pattern kind of fulfilled itself, and you can come to that conclusion. So in terms of year end, in equities, there's definitely going to be positioning wanting to be positive going into the end of the year. Um, and that's going to be supported. The other issue, tax loss selling, with everything up so much, and just about everything is up, that shouldn't be much of a problem. If you have a negative year where the market's down, a lot of stocks are down 15, 20%, you're going to have more tax loss selling because people actually have losses that they want to claim for tax purposes. In a year like this, tax loss selling should be negligible. So,
okay.
but I think
But
it's
but do you do,
important to
do
take
you
in as many inputs as you can. And again, the thing is extremes. Positioning only matters when it's extremely bullish or extremely bearish. Sentiment, I think, is really important, but only matters when it gets to an extreme.
But aren't we
Um,
aren't we at an extreme right now? And
we
I mean,
are.
but if you're an asset manager and you're not keeping up with the S&P, let's say this year, do you have to chase the market? I mean, at the end of the year.
You're going to feel that pressure.
Yeah,
There's no question about it. And I think we've seen that happen and manifest itself, Blake, in the push into the small cap, the Russell 2000. It's like, okay, I'm not comfortable buying the stuff that's up a lot. And in fact, we've seen rotation where they've sold some of the mega caps. I mean, the semiconductor index is 14% below its peak in July. That's a market tell. But my point being is to your question is that people are like, okay, what can I buy that I'm not going to get run over in potentially?
sure.
And the relative attractiveness of cyclical stocks and the Russell 2000 has been that game. So, in terms of a peak and a meaningful decline, I think the first quarter is more likely where we could see a decline of 5% or more in the S&P, in part because the seasonal factor, the FOMO issue is going to be supported. Like I said, there could be a dip when the market realizes the Fed has cut rates and it's the last rate cut for a while. They're not going to, unless we see economic weakness, unemployment rate starts to tick up more aggressively and so forth. I don't think that's going to happen right away. You think about it, we had 3 million people go through TSA checkpoints last weekend. I mean, so there's this bifurcation in the economy, but the top half is in pretty good shape and they're still spending. And that's not going to change overnight.
Yeah. All right. Well, let's jump into the dollar, Jim,
Yeah.
and go into your last couple of charts. Remember, we're going to cover the dollar and the S&P here. So
Yep.
the dollar, you've been looking for the dollar to really get hammered, and it looks like
Yep.
we're trying to form a top. What do you
I
feel? How
think
do you feel
so.
about this?
Well, again, taking a look at the bigger picture, the dollar dropped from 114 down to 99 last year. And in a sense, this sideways chop is correcting that big decline. And it's taken the form, at least from my perspective, of a wave A up to the 107 and change, then an ABC down to the 100.16, and this to complete wave B of this sideways chop. And then this rally up is wave C. And the only question mark for me is unless the dollar overlaps the high of wave one, which is 104, what, 64? I think one can make a case that there's still a shot that one more lift above 108.07 is possible. And again, if markets conclude that, hey, that's the last rate hike by or rate cut by the Fed for a while, dollar might get a nice lift out of that. But once this wave C is complete, I think it completes the corrective rebound from 99.59. And what that suggests is you had a $15 drop in the dollar index, then this big ABC that sets up the next $15 decline. And if the high was at 108.07 or 108.50, if the dollar gets above that number, you just subtract 15. And so that's why I've been saying there's a decline coming in the dollar index below 95. Now, the one thing I'm going to say, I did a lot of talking about tariffs in the December macro tides and discussing the dollar, Trump's view about the dollar. So if listeners would like to get the December issue of Macro Tides, send me an email, jimwelshmacro@gmail. I'll send it to you because I think as we go into next year, having a better understanding of what's Trump's view about the dollar, I think it's going to prove important. And to let the cat out of the bag a little bit, his view in the past has been a strong dollar sounds good, but in reality, it's not that good. And I just think that he's going to use the threat of a stronger dollar in his trade negotiations. But as a practical matter, he believes that a weaker dollar helps our exports, helps create jobs at home. And that's what his trade policy is all about, is protecting jobs and hopefully pulling more manufacturing and production back to the U.S. And so that would be supportive of him at some point in time sending a tweet out, along those lines. That may not happen until he's done with his negotiations. But my point is the pattern implies that we're nearing a very important inflection point. And I think on balance, people think tariffs are bullish and are going to be supportive of the dollar. And what the pattern implies and his past comments imply that I think the more likely path is we hit a high, an important high between now and the end of the year in the dollar index or early next year. And then we're going to see, I think, a significant decline next year.
Well, and could there be a Plaza Accord 2.0?
It's possible, and I'm glad you referenced that because I discussed that. I discussed really in the December letter. Historically, people say, well, the dollar moves based on interest rates. That's true. Trade and current account deficits, okay, fine. The outlook for the economic, outlook for the U.S. versus other countries, all those things play in. The thing that I have found over the last 40 years that has the most consistent impact is the philosophy of the administration. So the dollar soared when Reagan took office to the point it was up to 164. I don't think people realize it got that high.
Yeah.
And as you mentioned, the Plaza Accord in 1985, all our trading partners got together. It's like, okay, let's bring the dollar down. So from 85, it went from 164. By 1987, it hit 85. It's a hell of a decline. All right.
Yeah.
But once currency traders realized, oh, the US wants it down, we'll be glad to help them. you might remember, again, back in 2014, I was writing that the euro was set up for a decline. Why? Because Mario Draghi had made comments that a strong euro is actually causing our inflation to be lower than what we want it to be. And that's when it was at 138. And it then subsequently dropped to 105. So once that view was clear in traders' minds, Blake, they were more than happy to sell the euro aggressively. And historically, in the 90s, the dollar was good. Why? Because Robert Rubin constantly said, strong dollar is in the best interest of the United States. Bush, the dollar topped at 121. It dropped to 70 in 2002, dropped to 70 in 2008. Well, he had Treasury secretaries that kind of said, yeah, we believe in a strong dollar. Wink, wink. Like we really don't. And so my point is, if I'm right, that Trump at some point in time talks about, dollar strength is a theoretical thing, but in the reality, we'd rather see it be weaker. Then obviously that would support what the chart pattern is telling us is the most likely path.
All right. All right. Well, thanks, Jim. I appreciate that. Last chart. I know we've been going on forever and ever and ever.
Sorry.
Let's talk about the S&P here. I mean, what's going to stop this freight train?
I think once we get over 6,100, we're going to hit a short-term high. I think there's a pullback. Again, the trigger could be the FOMC, the realization that they're not cutting rates after this next meeting. Breadth has weakened considerably. I mean, this week we've had the S&P march higher, and there have been 2 or 3 days where the breadth was actually negative, more stocks up or down than up. So all that to me suggests we're stretched. That blue trend line connecting prior highs, we're not far away. So, 6120 possible, of course, but I think we're about to see a pullback of sub magnitude. And then the things we discussed earlier in terms of going into year end, the seasonals and everything else should be supportive. So you get a pullback and then probably another grind higher as we get into the end of the month and maybe early January.
All right, Jim. Well, we'll see. I mean, the top of that channel comes in around 6,200, I think. It's very similar to the channel.
There's a couple lines. One is the higher line, and I'm showing the more short-term one. So it could be that we get to a little over 6,100, have a pullback, and then have another final push toward the line you're talking about.
Always a final push. Always a final push. All right, Jim. I want to thank you for being with us. We missed you last week, and if you guys and gals enjoyed being here with Jim Welsh and having him back, make sure you tell him below and tell him in the comments, and make sure you give him a thumbs up. Subscribe to this channel so you don't miss any of this exclusive content that we do here on Trader Summit with Jim Welsh. Jim, thank you so much, and we'll look forward to speaking with you next week.
You got it, buddy. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.